Why is NAV reporting this cost? Where did the cost go? These are common questions I'm asked by clients. Therefore, I would like to walk through the basics of inventory valuation and NAV so that users can have a better understanding of the system's costing decisions. Today, we're going to go through a brief introduction, perpetual versus periodic inventory, the inventory costing methods, inventory transactions, the adjust cost process, and finally touch on some inventory reports. Hello, I'm Erin Neely, a Business Advantage Support Consultant at RAND Group, and I've been helping clients get the most of NAV for over 2 years. I work with my team to provide post-deployment support for Microsoft Dynamics NAV. We help clients increase revenue and lower ongoing costs by reducing inefficient processes through the more effective use of the software they already own. We help with things like software updates, custom integration, as well as provide technical support and customized training for our clients' staff. Some of the most common questions I receive revolve around inventory, and that brings me to our main topic, inventory valuation. Perpetual versus periodic inventory. These systems describe methods of how often inventory is tracked. In a perpetual inventory system, information on inventory quantity and availability is updated on a continuous basis. On the other hand, periodic inventory describes a system where information on inventory quantity and availability is updated on a cyclical basis. On a periodic inventory system, inventory may only be counted once a year. NAV is a perpetual inventory system. Therefore, inventory quantity and availability is tracked in real time. However, whether the inventory value is tracked in real time is based on NAV's inventory setup. This brings us to the question, what is inventory valuation? Inventory valuation is the dollar amount associated with the items contained in a company's inventory. However, not all companies use the same methods of tracking inventory costs. NAV has 5 costing methods available: the first in, first out method, the last in, first out method, specific cost, average cost, and standard cost. FIFO is the most common costing method we see. Therefore, we're going to spend a little time to understand how NAV determines the value of inventory under FIFO. Under FIFO, an item's unit cost is the actual value of any receipt of the item. It is assumed that the first items placed in inventory are sold first. An example of an item which would have this type of cost flow would be orange juice, because the oldest items would be placed on the shelves before the newer items. Let's take an example. Assume 4 units are bought during the first half of October. If 2 are sold on October 15th, what is the cost of goods sold and what is the current value of inventory? In order to answer these questions, I have created an item and posted transactions for our review. Let's switch to NAV. I'm going to open the item card for our FIFO item. Please note that on the Invoicing Fast tab, the costing method is set to FIFO. Now, I'm going to go to the General Fast tab and drill down on the quantity on hand so we can review our entries. On October 1st, I bought one for $5. Also on October 1st, I bought one for $5.50. I know I bought the $5 item first because the entry number 403 is smaller than 404. On October 8th, I bought one for $6. On October 11th, I bought one for $7. And finally, on October 15th, we had our sale. Now, what is the cost of goods sold for these 2 items? The easiest way to tell is by looking at the cost amount fields. The cost amount fields report that our cost of goods sold was $10.50. How did NAV arrive at this number? Well, this is the first in, first out method, so the first 2 items received are those that are sold. That is our $5 item and our $5.50 item. 5 plus $5.50 is $10.50. What is our inventory value? Our inventory value is those 2 items remaining on hand, the $6 plus the $7, or $13. So the cost of goods sold was $10.50 and the inventory value was $13. The next costing method is last in, first out. This costing method is very similar because an item's unit cost is the actual value of any receipt of the item, However, instead of the first item purchased being sold first, it is the most recently purchased item that is considered to be sold first. An example of an item that would have this sort of cost flow would be sand, because sand would be gathered from the top of the sand pile rather than the bottom. The third costing method NAV uses is specific cost. In this costing method, the specific item being sold is identified by serial number, and the exact cost of the item follows it. This costing method is ideal for large items, which are easily tracked. For example, car dealerships could track the cost per VIN number. The fourth costing method NAV uses is average cost. This method is one of the most difficult to understand. Under average cost, an item's unit cost is calculated as the average unit cost at each point in time after a purchase. It's based on periods. The options for the periods are day, week, month, and accounting period. And the calculation can be broken out per item or per item, location, and variant. Let's take a look at the way NAV calculates average cost. When NAV calculates average cost, it determines the cost of the item at the start of the average cost period. Remember, the periods can be set as day, week, month, or accounting period. It then adds the sum of the inbound costs that were posted during the average cost period. An example would be purchases. It then subtracts the sum of the costs of any outbound transactions that were fixed applied to receipts in the average cost period. These typically include purchase returns and negative outputs, or even undue receipt. It then divides by the total inventory quantity for the end of the average cost period, excluding the inventory decreases that are being valued. Now, let's take a look at an example together. Assume 4 units are bought during the first half of October. If 2 are sold on October 15th, what is the cost of goods sold and what is the current value of inventory? I've created an example in NAV using the same transactions as for our FIFO item. So let's take a look in NAV to see how the average costing method affected these same transactions. Before we look at the transactions for our average cost item, I would like to take a look at the inventory setup. So I'm going to go to Departments, Financial Management, Inventory, and scroll down to the bottom and click Inventory Setup. There are 2 fields on the inventory setup that pertains to the average cost calculation: the average cost calculation type and the average cost period. The average cost calculation type determines how granular your average cost calculation is. Is your average cost calculation per item or per item, location, and variant? If it is per item, location, and variant, then the same item between 2 locations can have different average costs. The average cost period is what determines the closing entries. In our example, it is set to day. Now I'm going to go back and we can look at our entries. I'm opening the item card for our average cost item. And I'm going to drill down on the quantity on hand field. Please note that these items were bought on the same day for the same costs as our FIFO item. However, our sale reports a cost amount actual as its cost of goods sold of $11.75. And if we were to run the inventory valuation report, we would find that the inventory value was $11.75. How is that possible? Well, NAV has a useful tool that breaks down the average cost calculation. So I'm going to close the Item Ledger Entries page and scroll down to the Invoicing Fast tab on our item card. Beside the unit cost field, there's an ellipsis. If I click the ellipsis, the average cost calculation overview page will open. Please note that there's a closing entry for each day. This is because our average cost calculation period is day. If I expand this tab, I can see the details. I see that there was an increase of $5 and an increase of $5.50. So the average of those two is $5.25. On the 8th, there was another increase. However, the $5.25 and the quantity of 2 was forwarded to the 8th, so that it was factored into the average when the $6 increase happened. On the 11th, we had an increase of $7, and that brought our average cost up to $5.88 for the day of our sale on the 15th. So we sold 2 items for $5.88, which is our cost of goods sold of $11.75. We also have a quantity of 2 on hand. So 2 times our unit cost of $5.88 is $11.75. An example of an item which may have this sort of cost flow is nails, because they are typically bought and sold in bulk. The final costing method is standard cost. With standard cost, an item's unit cost is preset based on estimated costs. When the actual cost is realized later, the standard cost must be adjusted to the actual cost through variance values. An example of an item which may have this sort of cost flow are items that have little to no cost fluctuation. Now that we have covered all of the costing methods, let's take a look at inventory transactions. When items are bought, NAV makes 2 types of entries, item ledger entries and value entries. Item ledger entries can be considered quantity tracking. They are posted in the item ledger entry as a record of the inbound and outbound entries for a specific item. Item ledger entries are created at the time of inventory movement, not at the time of invoicing. For example, an item ledger entry is created when a purchase order is received or a sales order is shipped. There is no item ledger entry created when either document is invoiced. What is created when a document is invoiced is value entries. Value entries can be considered value tracking. They are posted in the value entry table as a record of cost and adjustments to a specific item ledger entry. There can be multiple value entries per item ledger entry. It can be considered a subledger for each item ledger entry. So when an item is invoiced, the value is tied to the item ledger entry through the value entries. Value entries are tracked through expected and actual costs. Costs are considered expected costs when they are received or shipped. Costs are considered actual costs when they are invoiced. Now, let's take a look at an example in NAV. I'm going to open the item card for our expected versus actual item so we can review the item ledger entries. I want to draw your attention to the cost amount fields. We have the cost amount expected and the cost amount actual. There are values in the cost amount expected and the cost amount fields. They are both 4,000 right now. However, if we drill down on the cost amount actual field for this item ledger entry, which has been completely invoiced, we can review the history. There are 2 item ledger entries, one for the purchase receipt and one for the purchase invoice. By looking at the cost amount expected field on the purchase receipt, I can see that this item was received at $5,000. And by looking at the cost amount actual field, I can see that the item was invoiced at $4,000. Sometimes you may not know the cost of an item when receiving it at the dock. Sometimes you may not know for a while. So that brings the question, what happens when you sell this item before you've invoiced it? Wouldn't the cost of goods sold be overstated by $1,000? NAV has a process called adjust cost. The main purpose of adjust cost is to forward cost changes from cost sources to cost recipients according to the item's costing method to provide correct inventory valuation. So when an item is sold and invoiced before it has been purchase invoiced, the recorded inventory value of the sale does not match the actual purchase cost. Cost adjustment updates from adjust cost will update the cost of goods sold for historic sales to ensure that they match the cost of the inbound transactions to which they are applied. Let's look at an example. For this example, I've created a cost adjust item, and I've created a purchase order for this item. I've received a quantity of 1 for $5,000, but I have yet to invoice it. I have also sold this item already. I'm going to minimize this and navigate to our item card so we can review the entries. Opening our item card, and I'm going to drill down on our quantity on hand. Currently, for our sale, the cost amount is being reported as $5,000. If I close out of this and reopen our purchase order, I can change this cost to $4,000 and invoice it. As of right now, our cost is overstated by $1,000. However, if I go to Departments, Financial Management, Inventory, and Adjust Cost Item Entries, I can run this process to adjust my cost of goods sold to $4,000. It's important to check the Post Cost to GL button and run with no filters so all item numbers are adjusted. I'm going to click OK. And now we can go review our item ledger entries to see if the cost was appropriately updated. The cost is now $4,000. If we drill down, we can see that there was an $1,000 cost adjustment. Please note that depending on your inventory setup, the cost may be automatically forwarded. For example, if I open the inventory setup, and the automatic cost adjustment is set to always, then I don't have to worry about running adjust cost all the time. However, it should still be run periodically. If adjust cost is set to never, then you will need to run adjust cost nightly, or your cost of goods sold will not be correct. Now that we have a basic understanding of costing, let's take a look at inventory reports that deal with cost. The two reports I would like to discuss are the Inventory Valuation Report and the Inventory to GL Reconcile Report. The Inventory Valuation Report can be used to determine the value of your inventory as per the subledger. It includes in its calculation actual cost plus expected cost. Let's run this report for our 3 examples. The Inventory Valuation Report can be found under Departments, Financial Management, Inventory, and Reports. I'm going to filter for our 3 items and preview the report. Our average cost item reports that it has a unit cost of $5.88 and an inventory of $11.75, just like in our example. The FIFO item also has the same inventory as our example. However, it's important to note that the unit cost is the average of the remaining quantity and the inventory value. It's not necessarily representative of the unit cost. You should also note that the inventory value is expected plus actual cost. So if you have an inventory interim account, this value is included in this report, along with the inventory account value. The Inventory to GL Reconcile report breaks down the values further if you would like to review receipts and invoice values separately. The Inventory GL to Reconcile report can be used to reconcile the inventory printed on the Inventory Valuation Report to the amounts posted to the General Ledger and the balance sheet inventory accounts. Let's run this report for our 3 examples. The Inventory to GL Reconcile report is located in the same place as the Inventory Valuation Report under Departments, Financial Management, Inventory, and Reports. I'm going to run this report for our 3 items. This report can look quite daunting. There are so many columns. However, once you understand them, It can be very useful. We're going to go into each of the columns in more depth in a future presentation. However, I'm going to talk about a few of them today. The first column is the inventory valuation column. This is the value reported on the inventory valuation report. The next column is the received not invoiced column. This column is representative of what's in your inventory interim account, what you've received and not invoiced. The ship not invoiced column is representative of what's in your inventory interim account that you've shipped not invoiced. These two columns combined should make up your inventory interim account. Finally, we're going to talk about the invoiced value column. This represents what should be in your inventory account. Please tune in to a future presentation where we break down each of these columns. And that's the basics of inventory valuation for Microsoft Dynamics NAV. I hope you've enjoyed our session today. If you'd like personalized assistance with inventory questions, our one-on-one support team is available for all of Rand Group's Business Advantage support clients. When considering a new Microsoft partner to work with, you might ask yourself, why Rand Group? A couple of things to consider are that we originated in 1996 as a part of Heine & Associates CPAs. We have 100+ local professionals to serve clients. We have a 90% retention rate. We have offices in Dallas and Houston, Texas, and we are in the top 1% of Microsoft partners worldwide. For more information, you can email info@randgroup.com to schedule a private consultation, or you can call 1-866-741-8615 to connect with our support team right now. I look forward to working with you soon.